Hello and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. We're partway through earnings season here in Australia. I caught up with Scott Phillips at the Motley Fool to see who's getting an A for effort and who must try harder. Scott Phillips, a pleasure to catch up with you once again. Thank you so much for taking the time to talk with Dukascopy TV today.
Thank you, Natalie. Good to be with you.
Thank you so much. Okay, so we're in the midst of earnings season. We've had a lot of good reports out, a lot of less good reports out, but let's start firstly with the big banks. We've seen a lot of results out from them, but again, as I mentioned, in the midst of that, you've had ratings agency Fitch come out and warn that some of the banks may actually have to go through capital raising once more. How has this dampened perhaps some of the results that we've seen from that big four?
Yeah, particularly in institutional and retail investors here in Australia, the banks have been something of a safe haven. It's been the go-to stocks. Australia's property prices have gone up and really through the roof. That's really supported bank share prices. Everything's been great for our banks. This might just be the period of reckoning. We've seen some capital raisings already, particularly because our local system here, the Murray Inquiry, suggested the banks would have to hold more capital. APRA, our prudential regulator, has decided that's an appropriate thing as well. And as a result, they've had to raise billions of dollars of capital, quite literally. Moving forward, though, the chances are they're going to have to hold more capital, particularly if they want to keep lending at the rates they are currently. They've got two choices. Either they pull back on lending to replenish those capital stocks, or they go back to the market. And really, investors are worried that that's going to mean, and should rightly mean, lower share prices, diluted share counts, and really is going to weigh heavily on the market. Of course, here on the ASX, our banks are the biggest sector by a very long way, and so where the banks go, so the rest of the market goes. So not only are the banks themselves showing some degree of, I guess, wear and tear and under some sort of weight, but that also has meant the overall market is also just a little bit stagnant at the moment, not quite knowing where to go or what to do, because the big leaders, those banks that make up over a third of our market, really aren't sure where they're going to go until we have this capital raising resolved once and for all.
Now, mining and minerals company Arium is one of sort of the latest victims of reporting season, reporting a $1.9 billion loss. Pretty significant, really. And again, those results have massively tracked the iron ore market price, heading average 40% downwards. Now, commodity prices, they're looking like they're heading nowhere but further down. How really does this highlight perhaps future performance that we could be seeing from domestic miners in the coming period?
Yeah, it's a great question. The challenge of commodity prices really is weighing on all our miners right across the board. If the banks are the biggest sector, the miners were until recently the second biggest sector, and with good reason. You take the likes of Rio Tinto, BHP Billiton and others. The Australian market is dominated by the banks and the miners. And right now the commodity prices are absolutely just knocking them for six. We're having a real trouble now because there's a massive supply, particularly when it comes to iron ore, less so with petroleum, but again, the same thing with oil. You've got the Middle East countries and you've got US shale, you've got Australian liquefied natural gas. There's plenty of commodity supply coming onto the market and not a lot of demand growth. A little bit of demand growth, but Chinese steel production is flat to nowhere. Oil demand is reasonable, but again, not growing anywhere near the rate of growth of supply. When you ever have that imbalance, you're going to see lower commodity prices. And that's what's really dragged Arium down. It's what's weighing on the share price of BHP Billiton, of Rio Tinto, of Fortescue Metals. All of those businesses really struggling because no matter how well they run their operations, the commodity prices are going to matter. Moving forward, the challenge is there going to be a rebalance of supply and demand? The honest answer is no, not in any time soon, because there is still so much supply being added. They're all trying to grow production to make up for those price falls, which of course exacerbates the problem. The more production comes on stream, the lower the prices go because there's simply too much supply chasing too little demand. Arium was the latest victim of that. We're going to see more problems down the track. To some degree, hopefully investors have priced most of this in, yet they still surprise me every time there's a downgrade. Investors seem surprised by that. You've got to assume there's going to be ongoing prices. This is not the time for optimism with miners. That being said, there's a price you pay for all of them. Some BHP, Billiton and Rio particularly, very, very low-cost operators. Rio Tinto being priced at $16 a tonne for some of its iron ore, still well and truly below the current price. But the question is, do you factor in a rebound in commodity prices? I think pretty clear the answer is no.
If we take sort of separating the wheat from the chaff, then Greencross has actually been highlighted by some as being sort of the surprise star of reporting season. Would you agree, or are there others that have really marked themselves out as a standout?
Yeah, Greencross has been the number one, I think, Natalie. We've seen a real situation where Greencross was a vet company, a veterinary company, took over a pet retailer, and realistically, you add those two together, there's plenty of opportunity for things to go very, very badly if you think about it. If you're a great vet, you're probably not going to be a great retailer or vice versa. with Greencross, they've done a very, very good job. Surprised the market, surprised me. They've done a fantastic job of being able to find a way to combine those two businesses. They are complementary, as you would expect. You take your dog to the vet or your cat to the vet, you're going to buy some pet supplies and vice versa. It makes great sense for those businesses to be combined, but it was never a slam dunk. It was always a question of, can they make that transition? Can they be part vet, part retailer? And the answer is, at the moment, yes, they've done a spectacular job of combining that business. Lots of to and fro, capital raisings, M&A, lots of things going on in that space, but they've done a very good job of it. They've absolutely been the standout of the market. Other than that, there's been not a lot of great standout performance, quite honestly, which is probably good and bad. We've seen some reasonable performances by some of the big guys, still some to come, of course. So a really challenging time of the year. If there's any good news, or if there's a broader positive sign, I suppose, it's that there hasn't been a lot of bad news. So there've been a couple of bad news. You mentioned the miners, of course, the banks struggling. So yes, they are to some degree known entities. But the broad earnings sweepers have been pretty good.
How is sort of all that we've discussed and everything that you're seeing at present shaping your outlook then for the second half of 2015 for the ASX?
Yeah, exactly. Well, I mean, the positive news, as I've alluded to already, is that earnings have been reasonable. And I guess when you think about, the economy and the markets don't always track side by side. Sometimes you see a better economy in a worse market or vice versa. The positive news here is that there's good growth and profits here in Australia amongst the non-miners, non-bank sector. And again, that's a large chunk. But if you take that out and say, where else can I invest? There's been good profit growth. There's been good performances by some of those providers. That's been a good result across the ASX, I think. It also shows so far the retail numbers have been pretty good. So the consumers are out there spending. So broadly on an economic level, showing some resilience to the economy despite some concerns about more interest rate cuts possibly being needed. So that's a positive. And for investors, of course, you want to see growing earnings. And to the most degree, outside those two big sectors, we've seen some really good earnings growth and some good performers. A couple of ordinary performers as well, but broadly speaking, I think the overall tenor has been quite positive and quite good for investors.
Scott, always a pleasure. Thank you so much.
Thank you, Natalie.
Many thanks there to Scott Phillips at the Motley Fool for his comments today. I'll be back with plenty more exclusive interviews for you right here from Sydney, Australia. For now, though, it is goodbye.